Go ahead and hit record. Well, welcome guys to another Tactical Tuesday. Keith and I are both in snowy Alberta. I don't know if Keith about you, but my poor puppies, they're about 12 inches tall and they literally are buried in the snow. That's how much snow we have already in one day. So yeah, fun. Welcome guys. Today, Keith has joined me. Those of you that don't know Keith, you need to get to know him if you don't. Keith has been a standard in real estate investment circles since I started. And you know, it's funny, it's interesting how you see these faces over the years and they've always been around, and some are, you know, out there and really kind of loud, and some are just in the background watching, learning, and guiding. And Keith's one of those guys. He is Keith, I would call you a coach. You coach people, you guide people, and you help them to see the things that they don't see. And so, you know what, I've actually, one of the things I have in my brain about Tactical Tuesdays is to do an oldies but goodies series where it's just all the old guys. And sorry, Keith, you'd be part of that, but so would I. So oldies but goodies. But welcome, Keith. Thank you for joining us tonight on Tactical Tuesday.
Pleasure being here, Tiffany. Pleasure to see you again as well. Some of us look older, and then there's people like you who look younger. So I don't know.
Oh, I'll tell you what is the Zoom filter thing, because on Microsoft Teams, I don't look nearly as good because you put this thing on to actually help you like look smoother, and I'm like, dang, I wish I could go back to that. So it's all just like mirrors and smoke, honestly. But anyway, you know what, Keith, welcome. Sorry, let me readdress our audience. Guys, thank you for joining us. This is a good topic. Today we're talking about things that Keith sees. So Keith's an investor, okay? He's been an investor for 20 some years. He 10 years ago went into mortgage brokering because, like most of us investors that have been standing for a long time, we get bored. There's not much to do. After a while, when your portfolio is already stabilized, yet you love the game, but yet you don't need more or want more, you go into something else. So Keith is 10 years ago transitioned into mortgage brokering. He's seen a lot. He's also has the benefit of having been in Alberta. And Alberta, of course, cycles faster. We've seen more ups and downs. We have more recessions than the rest of the country. So we've got more experience, just the way it is. We can say, oh, well, he's not out of Ontario, so he doesn't know. Well, let me tell you, doesn't matter where you're at, a recession is a recession, a cycle is a cycle. So if you're in Alberta, you've seen more than most in Canada, and so lots of just experience and wisdom. I'm going to say wisdom. So if you're joining us for the first time, please let us know in the chat. If you are on a replay, please also let us know. Just type in replay, please. If you wouldn't mind doing that, that would be awesome. We are really trying to track the algorithm. Facebook's algorithm is like all over the place, changes every 3 months. We're trying to figure out exactly what it's at right now. So if you could help us do that, that would be amazing and awesome. In the meantime, guys, tell us where you're from too. And you know, I'm shamelessly, so Keith, I've been starting to ask for heart showers because when it was Corey and I doing it, he always asked for those heart showers because he liked them and it really drove him. And I was always like, oh, that's so weird of you to ask or whatever. That's hilarious. Now I'm like, I miss the heart showers. So I ask for the heart showers too now. I'm just going to make sure that we are live. I know that, guys, but I want to be able to see your comments. So please let us know where you're from. Ask any questions, guys. This is an interactive thing. We do this every single week since 2018. We do. Oh, there's some heart showers. Nice job, Keith. Since 2018, guys, we have been on here every single Tuesday. Now, I did have a car accident, but my head real bad, had a brain injury, was gone for 22 months. So I was not here for those 22 months. But Corey picked up the slack, and we have been here every Tuesday since 2018. That is a feat in itself. So we do this to keep on bringing you information and amazing people like Keith. So what we're going to talk about tonight is something that Keith and I both have this, and lots of long timers. I'm going to say long timers, Keith, instead of oldies. Okay. Long timers, we all have this concern is we're seeing what's happening in the market and we see that there's a danger zone that's coming up for this week, this month, this year. We see there's a danger zone for this year, this spring. MLI Select, it has been a blessing and a curse. We all know that. In Alberta, there are certain things happening. In Ontario, it's kind of going the other way. You already hit your recession. You may be bouncing a bit. Those that are investing in Edmonton, those are in a 6 to 10 unit kind of play. Multifamily investors, this is for you tonight. Okay, Keith,
Yes, Tiffany.
finally I'm going to stop talking and you can start. Please tell us a little bit about you. I gave you an intro, but tell us a little bit about you, something that we don't know. When did you transition? Why did you transition? What do we need to know? What do you got for us?
Well, let's see. So you mentioned I've been investing in real estate for over 20 years. In that time, I also implemented my own Smith Maneuver mortgage on my own primary home in 2005. So it's been 21 years now, and
Okay,
became
so let me
and be,
say, you must be a pioneer then, because that is about the time period that I was first heard about Smith Maneuver, wanted to implement it, but I was just so unsure about it. It was very complicated. And you've been implementing it for 21 years.
yes, I
Okay,
fully converted the mortgage over 2 years. So since 2007, fully converted, and
unreal.
became certified in 2020 when Robinson created this certification. Became certified in 2020, so that's coming up on 6 years now as well. I've although most of the properties that I have owned real estate are 1 to 4 units. I've done extensive training in the multifamily space as well. Worked on putting some deals together. Actually, I had a really big deal that we were working on right when COVID hit, and our investors got cold feet and backed out, and then the deal was gone. So, unfortunately, that piece of that got lost in
But yet,
2014.
yet that makes you able to sit and understand where investors sit when you win and when you lose
Yeah,
because you've had both. So
absolutely. Yeah,
yeah,
absolutely.
it just gives you more experience and wisdom.
Yeah, in 2014, I got into the lending game. I actually was a junior underwriter at Calvert. Um, we all know what happened in the market here in Alberta in 20 through 2015, 2016. And so last man in, first man out. And then I got introduced into the mortgage brokering world, and 10 years later, here I am. You asked for something people don't know about me. I'll give you two things. One, I jumped out of a plane and did a skydive on my 30th birthday. And the
No
other is
way.
that I am a wheelchair basketball referee, and I've been doing that for about 25 years now. And that's what I focus on. If anybody follows me on any of the social media, they see me posting when I am refereeing wheelchair basketball. I often do like to take photos and post because I love the sport, I love the people, and the sport deserves the attention. And it's not just people who are confined to wheelchair that play that sport. And so there's people who are able-bodied that just love the sport, want it different. It's a different environment. It's not so um, competitive. We all get along. We all know each other. It's a small community, very supportive. So I love wheelchair basketball. I've seen this country because of wheelchair basketball. And yeah, so
No way. Okay, so I'll tell you something, Keith. I look because I've known you or of you. We've passed in the same circles. We both have good reputations in the same circles for many years, which is again hard to find. So we've known each other, but we've never like really hung out or, whatever. So I had to look you up and I was like, I asked Claude AI, I was like, hey, so tell me something I don't know about him. And it's like, oh, he used to be an investor. I'm like, no, 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 that's boring. Tell me something fun. And they're like, he's a basketball coach for 30 years. I'm like, okay, that's cool. He's also a skier. Yes?
I've done some skiing, not a ton, not a
Okay.
ton.
And
And I
it,
can't, and now with my knee problems, I really can't.
Right. Yeah, yeah, yeah. Okay. So I think it's super cool that the change that I just learned is the wheelchair bit. And that's really
Yeah.
amazing. It tells us a lot about you personally too, and the fact that we can all do it. I love that too. So okay, so we are human beings. We are investors. We've run the gamut. We know what it's like to win. We know what it's like to lose in real estate. We know what it's like to not be sure which way it's going to go at any given moment. And after 25 years, and this being the fifth cycle for me, and so therefore I think for you as well, we also know the uncertainty, but we see the signs now. And I think that's such an important conversation to be having in 2026 is the feeling in the air, the
It's different this
crispness.
time, though. It's different.
It is. I agree.
It's different this time.
How?
To me, it's different because the conversation you and I, when we decided we're going to do this tonight, we didn't talk about what we're worried about seeing in the single family space because the single family space seems to have found its stable footing for the time being
Yeah.
as far as values go, as far
Rents,
as
even.
rents are going to be impacted inverse directly because of what's happening in the multifamily space. The biggest risk to investors right now is in the multifamily space. It's not so much in the single family space because a single family investor transaction generally happens over a very short period of time, within anywhere from 30 to 90 days generally. And
Right.
so, and the tenants are in and they're stable. You know where your rents don't really change much from what the time you purchased. If the tenants were already in there, there's not a ton of changes. Now, if you have a renewal coming up in the next few months, you certainly are likely going to see a change in your rents, but your value on your property isn't going to change where you're at risk of the bank coming to you and saying, your cash flow is now short. You need to give us a lump sum of money. And so
Right.
there's two, there's kind of two buckets of risk that are showing up. One is higher than the other right now. And so those are the two that we want to talk about. And which
Yeah.
one do you want to start with? You want to start with the existing property that's already built and has tenants, or do you want to start with those that are under construction? Where would you like to start, Tiffany?
You know what? I think under construction, and the reason I say that is because I am in Edmonton, I get a lot of people reaching out to me about, I mean, the blanket rezoning, which is huge and amazing and such opportunity for us here in Edmonton. And still, yes, it is, even if right now there's a lull, we just have to be smarter. But yeah, I get a lot of reach out about that. And I want people to understand the pause that's coming and the wait and the patience that's needed, but the patience that will pay off. So let's start with the
Start
coming
with the
one.
construction. Okay.
Yeah.
So I've had several discussions with many very experienced multifamily investors over the past few weeks.
Because you know
And,
them and
and
have for a long time.
yes, and
Yes.
some are newer ones that I've more recently met. So it's great
Okay.
because there's no preconceived notions about the information and knowledge.
Oh
And
yeah.
so it's great. And it's amazing how their view is on the same space that both you and I have as well. And the view is that there is a huge exposure risk to the investors who have their properties currently under construction using CMHC. Most of them, MLI, large majority are under MLI Select. And the rents that were used at the time that these letters of intent, the COIs were issued by CMHC and the lenders, most of them over a year ago or about a year ago, are now nearing that end phase of construction in the next 3 to 4 months. And there is a lot in some communities alone. There's in Edmonton, there's 80 units in a single community that's due within like April, like March, April, May.
Yeah,
And
I was
that's
just
just one
talking
unit.
to a guy that he has 100 units himself. Between like he's a realtor, so but he's invested in every project, but he has investors. But just his stuff in Edmonton, he says, I have 100 units. He's like, so I know what's going on here. So yeah, and just in this little community that I actually drive through twice a week. So Yeah.
Yeah.
So how do so
Let's not jump ahead to the how. Let's talk about let's go
what's
through
happening?
yeah, kind of, well, where it was and how we've gotten to, how we're getting to where we are today. So let's, in talking eightplex, there's everything from 6 to 12 plexes kind of that are going up. Most of them seem to be more in that 8. In Edmonton, it's 6, 8, maybe 10, but a lot of them are 8s. And so these eightplexes, these 3-bedroom main floors were being able to be rented for about 2,300 a month, including utilities. Some even potentially plus utilities when they were doing the estimates a year ago. And the basement suites were about 1,300, or maybe a little, maybe as much as 1,500. So
Wow,
you were
really?
getting, you could get close to $200,000 of annual gross cash flow out of one of these properties. You go today and you look at Rent Faster, those 3-bedroom units, you're lucky if they're 1995 with plus incentives, and those 1-bedroom basements are 1,000,
Okay, so okay,
including
wow. So
utilities.
$600.
So you're talking 600 to $900 cash flow per month per, like, per 2 units. So you're talking huge. You're talking 40, well, at $900 a month on 4 units, you're talking 3,600 a month over the course of a year. You're talking over $40,000 change
Okay.
in
And
value.
here,
And
guys, this is where, let's say that we say, okay, like, that's we just got to ride this out. It's just the way it is. There's an oversupply. We're gonna have to like rent things out and for a little bit less, but within a couple years, it'll be absorbed and we'll be good. And I do believe that to be true, completely true. However, what we're finding is because of the way the financing has been set up lately over the last 3, 4 years, this has created a problem that is somewhat new in that we didn't see it necessarily before. So, Keith, tell us what that problem is.
so the problem is that, yeah, your property value based on your property value when your COI was set was based on you being able to attain those rents at the time of your construction was completed. And your debt service coverage ratio is built into that. Problem is your rents drop doesn't mean that none of your other expenses drop. The only one that changes is your vacancy, and your vacancy rate has gone up. So as much as your calculation for vacancy goes down based on your rents going down, the percentage of vacancy has gone up. So your vacancy rate actually goes up. So your EGI is higher
Okay.
or it's lower.
So you said
So
DSC, so let's define that, and EGI. Let's define that.
yes. So DSC is debt service coverage ratio, which at CMHC you have to attain 1.1 or 1.10. So $1.10 of income to every dollar of expense. Dollar
Okay.
ten of
So
estimated gross income. So that's rent minus vacancy and any other potential additional expenses. Generally, it's just or bad debt, but it's generally on a new property. It's just going to be your vacancy. And then
yeah.
that is used against your expenses and determines your debt service coverage ratio.
Okay, so we need to be bringing in 10% more rent than we are spending on expenses, which is not easy to do, but great and fine. And we calculated that out, let's say last year this time, and we were like, woohoo, rents are high, we're good. And now we're going to be closing in the next 90 days, let's say. There's a lot of units closing in 90 days. And we're finding that we're perhaps break even. We're not at 1.1. We might even be under 1 for debt service coverage.
Or guess what? Because your rents came down, your cap rate maybe has stayed the same,
Okay.
but guess what changed? The value of your property. Now the
Yes.
value that
Why? Why?
the value of your property came down because your cap rate by your estimated gross income is what calculates your value. And
Okay,
so,
so
so
for those,
now, if it was,
Mhm,
and I'm gonna show you an example. So this
mhm.
property was purchased at 2.5 million and it appraised, say, appraised right at or close to that 2.5 million last year. Now with the lower rents and you go for lease up and your rents are $28,000 lower per year. Now you're 600,000, now your property at estimate, value estimate at CMHC to maintain your, maybe to maintain your DSC is only 1.85 million. Now you're $600,000 short on what's needed to be able to meet your property value.
Okay, so if that's the case, I'm $600,000 short. I'll just ask CMHC for more money then.
No, because they go off of the property value that they estimate based on your pro forma calculation.
So where do I get that 600 grand, Keith?
Well, I hope you prepared yourself with liquid, with some sort of liquid backup, or you go and find an investor who's willing to come in. But why would an investor come in on a property that's now undervalued?
Mm.
Or you cut your losses and run and sell so that you can not be a default on a mortgage that you're not going to be able to afford. So,
Okay, so here's the crux of our conversation, guys. This is the crux of our conversation tonight, is the fact that there has been a massive opportunity. There has been massive influx into a certain product in a certain area. And every time that happens, it happens often. And every time that happens, that creates, an overbuilding and oversupply, supply and demand. Of course, we know there's going to be a shift. Now, did you plan for that shift? Can you plan for that shift? The difference is that if you don't plan for that shift and you're coming up to closing in the next 90 days, you may have a bill of, in this example, let's say, and Keith's going to bring up a table where he literally breaks down the numbers of the differences of $300 a month per unit in rent less. What does that look like? And how much more money out of your pocket might that mean? But in this example, it's 600 grand. Where are you going to come up with 600 grand in 90 days if you haven't counted this in? So this is where, for one, I just want to say there's opportunity for those of you who haven't jumped in yet to the market. There's opportunity because guess what? There's going to be fire salers. There's going to be people who have to fire sale and get out. And you
and
know what?
they're already posting on Facebook, Tiffany. If you
Oh,
follow any
really?
of the different investor groups, you're seeing people already post about being in trouble.
Okay. So I haven't seen that, but that's awesome. See, that's why you're in these circles to bring us the information ahead. So that's awesome. There's opportunity. However, are we going to have a glut of stuff on the market for a while? Are we going to have lower rents? Are we going to have higher vacancy? Are we going to need bigger reserve funds? All of these things, guys, this is the conversation we're having tonight. This is the crux of the conversation is where are you going to get the extra 600 grand and how much money are you going to have to carry you through the next couple of years until that glut is eaten up? Can you still win? 100%. This is when others are greedy, be like Warren Buffett says, right? When when others are greedy, be fearful. When others are fearful, be greedy. Yes, there's a balance to find. So, Keith, should we jump into your example? Is this a good time?
Yes, we shall.
Okay.
So I kept this very straightforward, plain Jane with keeping things equal as far as what we're comparing. So this is based on an 8-unit property, saying that your property value was 2.5 million, and that's what your cost was to build, not going based on the appraisal was higher or lower. This is what we're going with. That your rents were $200,000 that when you did your estimates, you went into your CMHC application, you were at $200,000 in rents. Now your rents are at 171.
Okay,
Your
and that is
expenses,
approximately $300 per unit less than what you thought 12 months ago.
than what we thought they were 12 months ago. Yeah. So now we come
Okay.
down, but our vacancy a year ago, our vacancy was only 3%. Now our vacancy is 5%. So now our
Because
vacancy
there's an oversupply in the market of that product.
oversupplying the market. So now not only do we have lower rents, we have a higher vacancy. So that further lowers our effective gross income. But guess what? Our operating expenses don't change. Our property taxes still the same until till we run through a cycle with the city where maybe the property value comes down, where the taxes may be reduced, but at the beginning, they're going to be the same. Insurance, depending on your insurance provider, that's an estimate. Utilities, that's it. 500 dollars per unit per month. So about $6,000 a year. Repairs and maintenance, that's based on the CMHC standard. Salaries are CMHC standard. Management, CMHC standard. Miscellaneous and replacement reserve, these are all the CMHC standards. So you can see here, your net operating income just dropped by $32,000.
Yeah, wow. Your NOI, guys, NOI has dropped
Yeah.
by,
Yeah, your NOI just got hit, even with the same cap rate. But look at what happened to your CMHC value.
wow,
You just dropped $625,000.
holy Hannah. Okay, so let's recap. For those that are not numbers people like me, a drop in rents by about $300 per unit, okay, which let's say this in an eightplex, $300 per unit, that's about right. How is this going to trickle down? Plus your vacancy rate goes up. How does this trickle down? Here's the numbers. This is how this trickles down into actually affecting you. And light bulb allows us to prepare a little bit, if we haven't already, for what's coming.
Yeah, and so now your your challenge becomes now when we come down, yeah, your mortgage payment's lower, and yeah, your DCR is still okay. But the only reason your DCR is still okay is because your mortgage amount has now dropped to 1.764. If you were to
Okay,
try
so
to, and here's what's great, is I can do this live. I always like to save my numbers. If we were to try to do this same mortgage over here on this side and the same mortgage payment, look what happened to my DCR, now down to 954.
wow,
Now I'm below the limit.
right.
The only way I can get that up is I have to come up with more money to bring this mortgage down.
Unreal, hey? So, okay, this is awesome. Thank you, Keith. And you know what? Like, I'm just actually gonna just while you have that up, I'm gonna just take a screenshot of that because I want to look at that later, even yet. But yeah, what then if we're looking at numbers in real life?
How do you solve the problem?
How
Right?
do we solve the problem?
How do you solve the problem?
And there's multiple ways, guys, so it's not hopeless. However, if you're in this position, please reach out for help because you're going to need it.
Yeah.
And what we want to be doing is getting ahead of the trouble. I was gone for 22 months. When I came back to massive amounts of trouble across the country. And Keith, for me, it was, it had started rumbling when I was around, but then after I came back 22 months later, it was in full swing. Still, I'm talking to people every day about the fallout from that. And so what I really want to do is just be there for those that are in it now, see it coming, and instead of putting our heads in the sand, which I was guilty of at one point in Alberta in my investing portfolio, I just thought it's got to get better on its own. It doesn't, guys. We have to be proactive. But when we don't know how or who, It's
Yeah.
hard to be. So that's what we hope to bring to you tonight. Someone like Keith, who has been the gamut. Please reach out. Keith, how do we reach you in the meantime, actually?
So they can reach me by email, keith@enrichmortgage.ca. They can also text me at 403-614-8843, and we can arrange to set up a call. Here's the biggest thing that you brought up that's so important is people will keep their head in the sand as long as they can because they don't want to see the reality. The reality is, though, is whoever they had help them with their financing, they should be reaching out to them now to be rerunning their pro forma based on current market conditions to have an idea on what are they likely facing at completion. And so that
Okay,
they
so
can try to figure out whether that's bringing an investor in, do they need to refinance property to get access to equity? Do they need to try and find a joint venture partner? Do they need to be prepared to sell because the other options aren't available there to them? Is their builder, what's their builder's viewpoint? How did, like, where does the builder fit into this whole picture? These are all the things that they, these investors need to be actively looking at, thinking about, and working towards solutions on now, because what's one thing we know? Last minute money is the most expensive money to get.
right.
Always, always.
Yeah,
Last minute money is always the most expensive money to get. And
right.
builders don't generally want to wait for their money. And the last thing you need is to have a builder throwing a caveat onto a property and and messing things up even further. So plan ahead, talk whoever did your financing, talk to them, have them rerun the pro forma based on what the current actual market rents are showing, based on what you're seeing now. What you're seeing on Rent Faster, PadMapper, Rentals.ca, Kijiji, Facebook Marketplace, wherever it is you're looking, and you should look at many. When you see that people are advertising 1995 a month and a free month's rent, 1990 and other incentives, consider that those incentives cost money.
Yes.
1995 a month and a free month's rent. Well, that's okay. That's $2,000 a month less in annual cash flow that you have to then consider into your calculations, because that's $2,000 a month that if you want to compete, you need to be offering the same. So not only are your rents down, now you have to take out an incentive, and that impacts even further because 2,000 bucks, that's another $166 a month in less rent.
So now we're talking about 1829 in rent rather than 1995 in rent. So now we have to run our numbers at that real number. And guys, it sucks. And when you're in it, it's brutal to have to do this. But if you just think, oh, the market will correct, and I ran my numbers, I was smart, I did everything I should have, that's true. But guess what? There can be a axe thrown in any plan. And you've had one thrown in your plan. That doesn't mean you suck. That doesn't mean you're a bad investor. We've all been there. But those that stand after it versus those that don't are the ones that deal with it. And so we're really hoping that you understand there is a way, there are ways you can. So Keith is saying, reach back out to the person who helps you do your financing in the first place. I would argue that perhaps if they are not the most helpful or are not coming up with solutions for you, that maybe you reach out to Keith, because because not everybody has been around for a really long time and has seen these things and thinks creatively and out of the box. So Keith, you mentioned, and I kind of ticked them off on my notepad as we went just as dots. So you mentioned 5 different options. Can we just review though, like off the top of your head, you rattled off like maybe you want to do this, maybe you want to do. Can we just go through those a little bit
So
again?
so one of the things, so yes, reach out to whoever helped you to get them to redo your pro forma and verify what the potential impact is for you that you need to be prepared for. So that's critical number one. Now, depending on who they are and what their licensing is or not, they may not be able to directly help you with anything regarding residential mortgages that you may have or residential property you may have. Often they don't cross over. In my world, I have my team, we do residential and commercial, so we can. However, then that's where, so if when they give you those numbers and you get that shock, then that's where, yeah, your next call and conversation can be to me. And we'll talk about what are the potential solutions that exist. One could be, yeah, refinancing some of the refinancing or looking at secondary lending, whatever it might be, on existing other property you own to, to see, can you make up that difference? So that could be number one. Number two could be, okay, how do you get a joint venture partner to come in and help you with getting that capital, and you're going to give up some ownership on that property, but don't get locked in on that being the solution. If you have equity in property and you think it's cheaper for you to go and get a joint venture partner and give up potentially 50% of your deal of your property, your ownership, to get a joint venture partner in. Don't get fooled that you think that is cheaper than going and getting a second mortgage at could be 10, 12%. I can tell you
Okay.
in the long-term wealth plan, that 10, 12% is cheaper than the JV at 50%. If it's going to get you the capital you need to make the deal work.
And if you have that option, take it. And if you don't, go to option B or C and whatever it might be. But it's all about weighing the numbers. So, a lot of people say, I'm not paying 12% interest on a mortgage and whatever. And I get it. Trust me, I don't want to either. But what if that 12%, like Keith just said, what if that 12% is cheaper than giving away 50% of equity and future potential on
Because when
another?
because when other investors know you are on the ropes, and the risk for you is either you lose everything you've put into this deal potentially, or you take their offer of 50%, could be more. You take their offer and you run with it. Like that's where you are going. That he who holds the gold makes the rules. And in this case, they're going to be the ones that have the gold, and you're kind of going to be in a tough spot to be able to negotiate too hard. You've put a lot into it. Your soft costs, it's going to be things you can negotiate about, but you're going to be in a tough spot. And so, yeah, think of, here's the problem that we run into often, Tiffany, is people get focused on the number and they forget about focusing on the future long-term wealth in the plan. And make sure that impact of long-term wealth in the plan is considered in all of this. This is not, I mean, this mortgage is not a 5-year commitment or a 10-year commitment, whatever you took for a loan term on this mortgage. This is a 50-year mortgage. And
Long time.
that's a long time. Longer than most investors are going to be alive for what they took. So a lot of them there are many that I know had this plan that they're going to get the CMHC mortgage, they're going to do all this, then they're going to get someone to assume the mortgage. Fantastic. How do you get someone to assume a mortgage on a property where the value is dropped because now rents are dropping, vacancy rate is up? Now try to get someone to assume. They have to qualify for that mortgage. There's the CMHC fee is $100 per unit for reanalysis. That's not bad. But guess what happens on that reanalysis? Now the rents are lower. And this is where we were talking about, what about existing properties? Well, guess what? Guess what a commercial mortgage requires every year? A financial analysis. You pay the lender, whatever they said, $500, $1,000 a year. You submit your income and expenses and they do their analysis.
Every year.
Every year. If your debt service coverage ratio drops below the threshold, they're going to have a conversation with you.
Okay, let me just ask you. So all of you guys know I am not into the multifamily world. I invested as a private lender. I don't do it myself, nor do I have 25 years experience doing it. I'm in the single family world. So Keith, I am going to ask you the questions that come to my mind when I hear you say that. And so you're telling me that every single year, if I have an eightplex and I am under MLI Select, maybe I got this wrong, they are going to reanalyze my ability to qualify on that same property every single year.
They are, well, that's the lender is going to require, part of the requirement is that every year they do an annual review. That annual
And I have
review
to
is of
pay
your
them to do it.
income and expenses every year. And you pay them $500 to $1,000 to do that review. If when they do that review, if your debt service coverage ratio no longer meets the minimum threshold, they're going to be talking to you, asking you why. Was there an unexpected event? So maybe you had a flood, you had something like that. And so then, but then if you did have a flood, if you had proper insurance coverage and you had vacancy, you should have had vacancy rent. If you don't, that's a whole nother conversation. If you don't have rental loss coverage on your policy, you need to have rental loss coverage. You might say, well,
Okay.
my building's brand new. Why is it going to happen? Brand new buildings that are built this fast, they're the worst for having plumbing leaks and problems show up unexpectedly. I just like it's just and tenants leave pots on stoves and they burn things and they leave taps open, whatever. But the fact of the matter is, if you don't have tenancy rental loss coverage, now that could be a savior in your annual analysis because well, we did have tenancy off, but it's no longer income because it's rent, it's insurance payment, so it's no longer income. But that could be a reason. If you had extra vacancy, they're going to talk to now they're going to be going. They're going to well, why were you vacant for so long? And now let's
Right.
your rent. Say, okay, how are based on your analysis, to keep the DCR, we need more capital. We need you to put more capital. You got to pay down on this mortgage so that your debt service coverage is back in line. So
Yeah.
this is more likely to happen on existing rentals where those were, depending on where your annual renewal is in relation to where the market shifts. So if you have people who leased up, let's call it last spring, now their leases are coming up for renewal. Well, guess what's also coming up? Their annual review.
Interesting. I didn't
So
know
now
that.
you have two things colliding, and that what is included in that is lower rents. And
Okay.
what are tenants most worried about? Your pocketbook or theirs?
Yeah.
For $300 a month, and they can go and move into something brand new, even though yours is like, even though your place is great, they're going to be looking for you to help their pocketbook. And
Yeah,
so
for
in
sure.
the end, that's going to end up. Now, your annual review is based off of last year, your previous year. So you can likely be okay. But what if your annual review is in November and rents
Mm.
already started to come down when you last November, and now you've got a year and it took you a while to get rents and you ended up renting, like all these pieces start to come together. So those annual reviews can be another trigger point for more capital being required. So
Okay, and I love that when we spoke, whatever, a couple of weeks ago, you said like, okay, this sucks. Like it does. But this is the thing, is that those that take proactive measures, this isn't a death sentence, you guys. This is
no,
not, okay? There is so much that we can do, but you have to be you cannot put your head in the sand. If you are doing that, again, I am guilty of that too. I have done that at points, or in my early investing years. I was like, oh, the market, I ran numbers properly and the market will correct and it'll make up for blah blah blah. No, we are investors. The buck stops with us. We have to be proactive. So, Keith, if there's something proactive, it's talk to the person who originally got you your financing, have them run that pro forma again, see what options they have. If they don't, look for someone else. Keith is an amazing option. you don't stop until you find the solution. So you mentioned, just wait now. Where is it? Where's my notes? Uh, how do we, no, 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 no. Oh, value add. You mentioned how, okay, so we're talking about, let's say in some markets, we've lost $300 per unit in cash flow. We think, well, okay, that sucks, but it's, it's not too bad. And then we look at the number, this is the comparison, the table you showed us, and we go, oh, wait a second. This is going to make a $600,000 difference that I have to come up with in cash. How do I proactively add value? Now, your notes say creating new sources of cash flow, tightening expenses, and smart upgrades. So, what are some of those things?
So look at your value adds that you can start to add in. So do you have the ability to, you weren't going to allow pets? Maybe you need to consider allowing pets and charging a monthly pet fee for allowing pets. So
Like $100 a month
that could
per
be
pet.
one. That could be one.
Okay.
What parking, generally you can't charge for parking on these. And so that, but maybe adding electrified parking, so then you can charge for some parking. If you didn't have that part of the plan, possibly that's a tougher one. What about
But you know
storage?
what?
What
RV
about storage
parking,
units?
storage. Yep.
What about storage? Most of those units do not have a lot of storage, but guess what? Those tenants need. They want storage. So what do? They go to the U-Haul and they pay $300 a month for their small U-Haul storage space. Maybe you can find a way to add some storage onto your property. What do
So,
you
for
do?
example, the sheds from Costco, they're
Yeah,
1,200 bucks. They are not mouse proof, let me tell you that.
no,
But I know from experience that people will pay you $400 a month to store their stuff in a 12 by 10, I think it is, shed that you put on your property.
yeah. So that can be a solution. Another one is, what do you do for expenses? Now, how Edmonton and Calgary do waste management are different. Edmonton, the city controls your waste management on these properties. Calgary, it's independent, so you can do some negotiation. So that's a little different in between the two cities.
Okay.
How are your utilities set up? Because you have to have the utilities in your name on these. You can't do the utility because of how CMHC's rules are. You have to have utilities. Your leases have to be, my recommendation is that your leases should be rent plus a utilities addendum. A fixed rate utilities addendum is what you should have on your lease. And so your
Okay.
rent, if your rent's going to be 2,000, if and that's where you have to do your market now. Is the rent 1995 a month including utilities? And some of them are that low now, or is your rent 1995 a month plus 200 a month in utilities or 250 a month in utilities? What is your fixed monthly utilities? But guess what? There are ways where you can make money off your utilities. And so
Do tell. Do tell, Keith. Do tell.
and this doesn't apply just to multifamily. This applies to any investor. And I'm working with many investors now and helping them get this set up. And it could be $100 a month extra cash flow in your pocket. It could be $1,000 a month extra cash flow in your pocket, depending on how you do it, what you do. But so Tiffany, when you get new tenants, what do they need? They need utilities. They need a tenant insurance policy. They probably need internet. They may or may not want TV. A lot of
Mhm.
people just do streaming, so they just want good internet. Maybe they want
Yep.
security. Maybe they want home security. So those are things that you could put together in a package and offer your tenants, and you can residually make income off of all of those because of the program that's out there through ACN, which I've been a part of for many years. And I just in my residential lending, I generate several $100s a month in extra cash flow just
Hmm.
because I invested $400 to set myself up with a business, pay $30 a month, and now I generate several $100s a month. One
No
time,
way. You know what? I signed up with ACN, oh my goodness, years and years ago, only because a family member was in it and needed someone. And so I was like, okay, I'll invest in you. I never did anything with it, but look at that. That's interesting. So interesting. I never ever thought of that kind of collaboration.
well, when you think about, okay, so even if we take, well, you know what? I'm not going to take internet. Let's take TVO. We'll take TVO.
Sure.
You need electricity, you need gas, you need a tenant insurance and policy, and you need internet. So there's four services that every unit needs. Every unit. So if that's 8 units, that's 32 services.
Amazing. I never thought of this, Keith. Never put that together.
And it gives you the ability to likely offer them all of those, well, utilities, but all of them at lower rates to your tenants. But
Hmm.
guess what? You don't have to give it to them at the rate that you're paying because you're providing it and you're providing it as a service. Now it gives you an edge over someone who's not because you have the ability to set them up with all of those. They don't have
So
to,
for
you can
those,
simplify the process. Because what's one of the biggest problems you have when it comes to tenant and having tenants? Yeah, call this and just call your insurance, or call this person, set up your tenant insurance. You're down to the day of the lease, and you're like, I haven't received your tenant insurance policy yet. Oh, well, yeah, I'll do that. As opposed to when you meet them and you get together and you get on the Zoom to sign the lease, or you meet them in person to sign the lease, let's get your tenant insurance application in right now. Let's get it done. Internet, we've got you
okay,
covered.
so just for those who've never heard of ACN, so ACN, let's
So
let's say that
historically, it's changed. It's from what it was to what it is now. It's completely changed. It is
okay,
well, it's really an affiliate business model.
yeah, okay, yeah, right. It was probably one of the first affiliate business models, really.
Yes, and it's
Yeah.
not based off of. It's not based off of MLM where you need other people to like.
Even
It's
if it
B 2
is.
C. It's B 2 C. It can be B 2 C. Your rent tenants are your customers. It can be B 2 C. Like that's it.
Okay, so just to clarify and just to give it context for those that are not familiar with this, and this is actually huge for any multifamily. I'm my
It's huge
brain
for
is
any
just
investor, period.
I'm spinning, Keith. I'm spinning just with this alone. Now we're going to have you back on because we want to talk to you about the Smith maneuver. And what I want to talk to you about is the fact that I have Smith maneuver all set up and have for many years, but never really implemented it properly because it's a pain in the arse. And so you're saying there's certain things you can do to automate it, and you're going to walk us through some of those workflows, which is awesome. So we're going to have you back on for that. Maybe at the same time, we can also do a walkthrough of this, kind of ACN, what it is. But in a nutshell, guys, just to explain it, if you haven't heard of it, I'm going to say really simply, but the idea is, let's say you get wholesale pricing on certain services, and you then have the opportunity to offer it out to others under your referral code, let's call it. And through that, you can set the price. Let's say I pay $100 a month for tenant insurance. I wouldn't, but let's say that's my contract with ACN, or $100 a year, let's say. And then, I decide to charge my tenants 110. So you can set it. You can charge them 180 if you want. It doesn't matter. 500 or 110. And that spread is kind of where you can make some money. So Keith is saying there's value add where, you have to create new sources of income and tighten up expenses. This is a really interesting way to do that. So yeah, really cool. Keith,
ID
would you?
protection. I You can offer your tenants ID protection.
Interesting. Yeah. Okay. I want to continue that conversation. That's a whole other conversation though. And I even need to wrap my head around it to really even be, I think, understanding the full scope, but that's really cool. Okay, let me see what time are we at. Okay, yeah. We're done though. So Keith, someone was asking, they didn't catch your number. Can you repeat that?
Yeah, my phone number, I'll put it in the chat as well. You pop it in there. But my number is 403 614 8843. And
Where do I also find you? I love looking at websites of people before I actually contact them because I just want to kind of get a heads up of the kind of stuff that they offer or do or whatever. What's your website?
I'll put it in the chat. It's demystifyingmortgages.com.
Right. Okay. Now I'm just going to, the chat is not seen in Facebook. So 403 614 8843 is the number. Email Keith, Keith. I never remember if it's EI or IE. So KEITH at enrichmortgage.ca, and website demystifyingmortgages.com. So, Keith, thank you for being brave enough to open this conversation and say to people, guys, there's something coming, because sometimes the bearer of bad news, we get bad rap. It's like, I am only trying to protect you. However, we do get bad rap for, oh, be positive or whatever. How about let's just be real? This is a real conversation. Things are happening. If we put our heads in the sand, we're going to get burnt. So thank you.
Be real. Everybody's situation is unique and different. This doesn't mean that this is going to happen and exist for every person who's doing one of these builds. It means open your eyes, rerun your numbers with your lender to do a double check. If you're fine, if it looks like you're great and you're in good shape, perfect. Then you've got your sleep at night is going to be much better. However, I can almost guarantee that most people that are in these right now, they're seeing what's going on. They might be hiding it, but somewhere in the back of their mind, they already have a concern about what this means. And so get in front of it to understand it so that you can then prepare for it. Because nobody likes to see who's swimming without their shorts when the tide goes out.
Actually, I kind of think that's fun to see, but that's just my twisted sense of humor. But yeah, we don't want to be the person. We don't want to be the person. So yeah, thanks, Keith. You've really given us lots to think about tonight. So hang on with us. We're going to jump into Ignited Laser Session. So if you just want to hang on right here, we're going to love you and leave you here over on at Fearless. So we'll jump into our Ignited coaching session right now. Thank you for joining us for Tactical Tuesday, Fearless. We really appreciate it. If you are in that position and you need a hand, you can even put a comment in the replay or in the feed, just saying, you know, I could use a hand, I could use a reach out. And that's to Keith, certainly. But if you're too shy or there's something that you're embarrassed to talk about and you need some one-on-one help too, feel free to reach out to me. I was the underdog for so long and for so many years that if you are in that position right now, I'm more than happy to help. I'm doing every single day. I'm talking to people. So yeah.
No judgment. No judgment.
No, right? No judgment. We've all been there. That's why we can stand here with saying no judgment. It's more just heartfelt. So that's all. Yeah.
You're only judging yourself.
Yeah.
You're only judging yourself.
Yeah. And you think you're the only one. Little do you know that everyone is sitting in that position. And yeah, everyone's afraid to. So, okay. Thanks, guys. Cheers, everyone. We'll see you next week for Tactical Tuesday. And Keith, just hang on with us for a second here.